the fundamentals remain solid. We've talked about this 12% growth, net profit 6.5 billion, profit before tax still 17% increase year on year. We've tried to understand what exactly has driven this result. So one of it is cost minimization, and we know that you've tried to streamline. But give us what you think are the key drivers.
When we looked at our strategy and we started looking at our structure, especially on the sales structure side, our branch distribution network, we focused heavily on rejigging the team, making sure that we had the right people put in the right roles. Right. And then we focused on which markets were the ones that were going to give us the right amount of the right sweet spot in terms of revenue. Right. From the division of the business, retail, SME, corporate. If we recall, 2 years back, our corporate business was a little bit in the doldrums, growing. I think growth was roughly 11% year on year. But we've had a great foundation in our retail business, especially on the back of mortgages. And a sustainable growth in unsecured lending, but which is security or insurance wrapped. Our SME business has also grown steadily at north of 25%, CAGR over the last 5 years of 25%. And then this year, standout out of the three businesses being our corporate business. And that's focusing on the large ticket investments in infrastructure that have taken place within the country. Right. From the new Bugusera Airport, the peat-fired power plant. We've seen ways to support those infrastructure growth, heavily focused on construction. And that's been kind of a key. So although we've kept costs low, we've been able to drive the business quite well.
All right. Now, you've created context, so now we can break everything down. Let's get into it. We've talked about the prospects for, first of all, banking. IFRS 9 has come into question, and analysts back and forth have said that provisioning might not be good for our markets. I'd like you to tell me about that and how you think this will play a role in either your next reporting before we get into most of your variables.
Okay, so from an IFRS 9 point of view, so if we look at our numbers under IAS 39 at the close of last year, we were well provisioned. I showed you some statistics with regards to our provisioning numbers vis-a-vis the market, and I think we're in a good position. So the difference, the cut over into the new year was only in the region of 200 million, and that we will take out of, in terms of the rollout of IFRS 9, we'll take that out of reserves as opposed to it affecting our P&L. Okay. And that's for a smooth implementation across the sector within Rwanda. I think where IFRS 9 is going to hit banks on the whole within the market is understanding pricing for risk. And that's a whole journey that we're all beginning at the same time.
Right. And are you able to counter that with your local reserves or your FX reserves? How are you able to work that out and still work out the FX conversation?
No, in terms of those taking from reserves, we've taken out of reserves that we've built up in our retained earnings over the years. So it's a straight
pick and grab.
Yeah.
All right. Let's move on now to matters on risk. Your NPLs are still very low. We've talked about it, around the range of 2%. So the bank seems to be very stringent on risk, or they're trying to shy away from the same. Maybe you could guide us through what we are not observing.
Okay. In terms of that, it's not shying away from risk because our assets grew north of 30%. Right. So it's more that management of taking the right risks in the right areas. One of my colleagues sent me a note today to say, nice set of results at one of the other banks, and I said, we worked really, really hard to be lucky in this market, and I think that's some of it. But we've looked at our credit processes. Obviously we stick or adhere strictly to credit underwriting standards. We haven't done anything that's untoward. We think that growth is adequate with regards to the risk that we have taken. Right. It's not like we've come off a low base, but compounded annual growth rate over the last 5 years has been roughly 20%.
Okay.
So we maintain at the trajectory. And if we look at our growth vis-a-vis the market, banking growth is a leverage on GDP growth. So, and it's usually 3 times GDP growth.
Right.
So if GDP growth is roughly 6%, that's 18. Then we've gone a little bit higher than that. Maybe we've won back a little bit of the market share we lost 2 years ago.
Right.
You know, swings and roundabouts. But we're comfortable with, and I think it's fundamentally that credit underwriting standards and sticking to strategy, almost ruthlessly sticking to strategy.
You mentioned 2 crucial points. Number one is your assets and, of course, liquidity. We'll start off with liquidity. We anticipate that your customer deposit growth is well linked with the RSSB. Is that the case, or how do you intend to grow this?
No, it's the opposite, actually.
Right.
If you look at our reliance on wholesale deposits to fund to grow our deposit book, you'll see that we are heavily swayed towards current account savings account.
Right.
Around about 75% of our entire book is sitting in current account savings account. Our reliance on wholesale deposits has diminished over the last couple of years. I wouldn't say it's lessened in terms of overall amount, but if in terms of aggregate amount vis-a-vis the other deposits, we've been able to grow, and that's transaction banking, good products, opening the doors to new customers,
right.
Especially our Malaika account that we launched last year. Going into the student market has been a massive eye-opener for us, because we want to target the young professionals.
Right.
We want to get them as they enter into the job market, and then grow with them over their lifetime of their banking needs. So we've seen that. Last year we ran a campaign for 3 months in the last quarter of last year.
Right.
We had 13,000 accounts opened up in that period.
Right.
And that is directly related to deposit growth. And at the same time, we're quite proud of the fact that our dormancy ratios are as a result of those campaigns. You know, usually people see, you can win a motorcycle, a television, etc. Let me open up account, and then I'll close it again if I don't win the product.
Or a Visa card, or a card, actually.
Yeah.
I'm guilty of that. Of course, the second point that I wanted to mention, a point of concern is your assets are increasing, but why would amortization go down?
In terms of?
We're trying to see the provision that you have year on year. If your assets are increasing, why is it lowering as you move on, yet your asset base is still burgeoning? Under
the new IFRS provisioning now, if you look at our provisions vis-a-vis the book, you will be booking provisions as if we've drawn a line in the sand as at the 1st of January,
right,
and said, okay, bring up your provisions to the percentage that it's calculated vis-a-vis your loss norms, your expected losses, etc., across the book. And you will make those adjustments on a monthly basis. So as you grow your book, everyone will be caught up in line. So there's no anecdotal measurement, etc. It's not something that a board sets. It's now set via legislation. Right. If we look at our provisioning on Class 1 and Class 2, that was set, we were running that in parallel during the whole of last year. That was guidelines set by the central bank. We were well in line with our provisioning. So I think we're on track within our provisioning for the book. All right.
I know your staff is watching. You have strong results, but they need to know what happens in terms of employee benefits, and I touched on this. Employee benefits are barely 5% year on year. We need to know what's being done either to rectify that or ensure your staff that things are pretty solid for them as well.
Okay, we've come in with a good increase this year. Obviously, the board is pleased. We want to retain our good staff. We've had really low staff turnover rate over the years. We've maintained it well within industry norms. From a staff point of view, we've seen some costs because we took permanent staff, put them into the project, and there's a capitalization of some of those costs. So obviously it had an impact on reducing costs. But that's not the whole reason. We want to keep in line with inflation, so we keep our staff in line with inflation. But we do have the ability, and remember, we accrue for bonuses over the year, and we are able to pay staff bonuses. So there's a nice variable in it for staff and performing staff. We're a performance-based organisation, so performance staff get get rewarded. And this is the time when we start talking about that. So there'll be a couple of happy people in the next week.
In the short term.
In the short term.
Last point has to do with your dividend policy and the share performance. We talked about this as well. In other markets, when you're talking about such results, you would see the market respond to it, and the share price would also reflect. But Rwanda's economy or the market right now is very rational, not very speculative. 97 as we speak, Rwandan francs. Where do you see this going to, and in how long? And what do you now have in terms of prospects for the dividends?
Like you say, we're a little bit disappointed. We're really excited about our results, and you'd think we'd see some creep. Unfortunately, all the shareholders are saying, no, we like the results, we're holding on.
Right.
So they can't be tempted into selling. I think this is our first year of real real scrutiny by the public. We've been able to put our money where our mouth is. We've returned a set of results that are better than what we even thought we would do when we launched the prospectus for the offer for sale last year. In terms of how the share moves, I think we're going to have to simulate that, and I think the way we'll do it is in the future. It's not imminent, but in the future we'll look at bonus issues, splits, etc., to put some stimulation into the market. We've seen a lot of interest from external parties looking to invest in our shares. That's where the biggest portion of the purchases have been over the last year. So we've been recognized outside of the country, and obviously we have our local investors as well. We focused heavily on that when we went to the market in terms of broadening our investor base. I think we have more than 1,000 small investors that we feel are as important as the institutions.